Stocks are having a little trouble today as Target's blow-up is dragging consumer discretionary, and tech companies are dealing with a forecast cut from Micron. However, the last month has had some pretty good technical developments. Let's talk about it with John Kosar joining us, the chief market strategist at Asbury Research, who's had some pretty amazing timing the last year and a half here. John, welcome back. Good morning.
Thank you. It's good to see you.
Your Asbury 6, am I correct in saying it's all green, your internal metrics assessing the health of the market?
They are. The model, in order for the model to turn actually positive, 4 of the 6 have to be green. That happened back on October the 18th, and the market's up just a little bit over 8% since then.
Yeah, I remember last time we spoke, you were becoming more bullish, more optimistic. We can see that the stocks versus high yield, one of the first ones to turn here. The breadth that started turning around late last month, and then earlier this month, the rate of change. So more recently, you get flows joining in, trading volumes, and corporate bond spreads in particular. So is this reflecting perhaps economic stability, do you think?
Yeah, when we look at corporate bond spreads, we're looking at them from a really short-term aspect, let's say. It's very sensitive, but when they start to come in, it indicates that the bond market's getting a little bit less apprehensive, a little less jumpy, and that's usually good for the market.
And yes, your metrics can move at any given moment. You've had several. I mean, obviously, it's a very dynamic thing. Do you measure kind of how far they are in positive or negative territory, or is it just binary? Like, are we far in the clear, or do any of these look fragile?
There's a couple of fragile ones, but if my memory is right, I would say 4 of the 6 are safely in the green. So it would take more than just a bad day to flip the indicator. And we're actually up against a major resistance now in the S&P 500. So I wouldn't be surprised if we, at the very least, have a pause here and take a look at it. It's about 4,100. But to answer your question, yeah, sometimes I can see. The last time I was on, I said that the indicators looked like they were close to turning positive again. Yep. And they actually did that 2 days later on October the 18th.
Yep, 100%. I recall very specifically. The pattern for the NASDAQ that you point out in your note to clients, I think, is pretty interesting. The inverse head and shoulders. Does that mean it could catch up to the Dow here? Because the old school 30 have been the leader.
Yeah, I mean, if this is the start of a new major bull market, which would mean we'd need to get and stay above 4,100 in the S&P, we're going to need some help. And the likely place to look for that help would be from both of the NASDAQs, from technology. It's difficult for the market to rally unless you have that leadership from tech. So I'm looking at the chart now, and we had a breakout after kind of basically moving sideways for, looks like a couple of months on the chart. We broke out on November the 11th. It targets 12,900 if we can stay above 11,500 in the NDX. If we slide back underneath there, the implications of the pattern go away. But right now, above 11,500, it points to 12,900, which is about 200 points above its own 200-day moving average.
Okay. So the kind of lagging nature of the NASDAQ lately maybe gives it a little bit more room to run if we've got a broader move. And as you mentioned, the bond spreads, to kind of try and imply some degree of causality for this. Rates calming down. How do you pay attention to bonds outside of spreads, John? The 10-year has now gone several weeks without making a high. I imagine that's part of the reason we're getting some confidence.
Yeah, I think so. The linear correlation between TNX, which is the CBOE 10-year bond index, and the S&P 500 have a really close relationship to each other for the past year. 410 is a big level in the yield of the 10-year. And we've been flirting with it. We've been up above it a little bit. We've been down underneath it. So I think the longer the 10-year stays below 4%, the yield of the 10-year stays below 10, I think it's going to indicate that the bond market thinks the Fed is close to being done. You know, it's a discounting mechanism, so it's looking off into the future. But underneath 4% in the bond market, to me, is just a little bit more fuel for the stock market to go higher.
Yeah, it certainly helps to not have rates ripping upwards. Long term, it seems like our extreme move in bonds too. Did we break free of that long generational downtrend in rates the way you see the chart? If we do get relief, will it just be temporary now that we've broken out from that long downtrend?
Yeah, I mean, that trend that it broke, I think the origin of that trend was early 2000s, and we broke that in March. I don't remember the level. But we broke higher from that in terms of yield back in March. So, yeah, but I mean, we came, as is often happens in the bond market, you know, you do nothing for 3 months and then everything goes crazy for 2 weeks and you make a big move. So this 410 area can hold for a while. And if it does, like I said, it's going to be good for stocks. If it doesn't, the next giant level that I see, I mean, discounting smaller levels that most people would see as not being very important. The next level for bonds is up in the 5 handle. So this 4, it makes the bonds' ability to hold this 4.1 even more important because bonds tend to jump from big level to big level, and the next big one is over 5%.
Okay, there's that look at the long-term chart here. To your point, 4 basically cuts us right through a big section from the mid-2000s. So an exciting moment here to see how we respond at this level. Any sectors, any themes that stand out to you, John? How far are you drilling down here into the leaders of this bounce?
We have another model. It's called SEAF. It's an acronym for Sector ETF Asset Flows, and that has done quite well. It's actually outperformed the S&P 7 in the past 9 quarters. Right now, it's overweight financials since the very end of last month, and it's been overweight energy since October the 10th. And both of those are making money, outperforming. That's where the money seems to be going to right now, and it seems to be coming from consumer discretionary. So what it does is it tracks the asset flows around the 11 sector spiders. Tells me where the money's going, tells me where the money's coming from within that 11 sector universe. And right now it's going into financials and energy.
All right, there it is. That's the rub. John, great stuff. Love all the details. Appreciate you walking us through the strategy.
Have a great day. Good to see you.
You too. John Kosar, Chief Market Strategist at Asbury Research. Indicators all pointing green. Definitely a good sign for bulls, as that Asbury 6 has been pretty spot on at most of the big turning points.